Okay. So here, pricing an illiquid bond. So it's a very simple one. Don't go by the formula. It is just a common, proportional method only. Common sense and proportional method only. Okay.
Okay.
So Rob Phelps CFA is estimating the value of a non-traded 4% annual pay A plus rated bond that has 3 years remaining until maturity. So that means it is a 3-year bond.
Okay.
Okay. 3-year bond. He has obtained the following yield to maturity on similar corporate bonds. Okay. So basically what happens here is uh, based on other publicly available bonds, we are going to find out this information about this non-traded bonds. That is what this question is all about. Okay, other uh, based on other publicly available bonds, we are going to find out some information about these non-traded bonds. So what are they asking? They are asking to calculate the value of the non-traded bond. Now, to calculate the value of the non-traded bonds, what do we require when we calculate value? So we require, see, this is what we want to calculate. So we require N. They already said it is a 3-year bond. Payment, they said 4%. That means 4 rupees. Then future value will be 100. So now what is missing here is IY. If I get this IY, then I will get the present value also. So now to find out this IY, I will take the help of the publicly available bonds. Now these are all the publicly available A plus rated bonds, similar bonds. So based on this, how will I calculate IY? So their IY is given. Okay, so this is 2-year and this is 5 years. So this 2-year bond, a YTM is 4.3 percentage. And this 5-year bond YTM is 5.1 and 5.3. So you take the average because they have given two rates. So average will come to 5.2.
Oh,
Is it fine? This step is okay till here.
yes.
Now, now we want to find out for 3-year bond. What is the YTM for 3-year bond? So how will we find out 3-year bond YTM? That is the only question. Okay. So 3-year bond, how will you find out? Just proportionately see. In 3 years, it is increasing by what percentage? 0.9 percentage if you take the
0.9
difference.
percentage.
So we want to find out for third year. So in 3 years, it is going up by 0.9 percentage. Each year it will go up by what percentage? So 0.9 percentage divided by 3. So 0.3 percentage, correct? So each
Yes.
year it is increasing by 0.3. So that means for the third year it will go to 4.6 percentage. 4.3 plus 0.3.
Hmm.
Is it okay?
Yes.
So that's it. This is 4.6 percentage. And find out the present value now. Calculate. Is it done?
Wait.
Hmm.
98.35.
That's it. This one.
Okay.
Okay. So you can ignore these formulas and all. So you just write down the steps properly now.
Done.
Now similarly, this sum also. Just go through this sum. So here, so 4 year, 5 year, and 6 year. They have treasury bond as well as corporate bond. So 4 year treasury bond is giving the YTM of 1.48 percentage. 5 year corporate bond is giving the YTM of 2.64 percentage. Then 6 year treasury bond is giving the YTM of 2.15 percentage. So these are the given conditions. Then estimate the required yield on a newly issued 6 year. Okay, that means this is what we have to find out. Okay, this is what we have to find out. So how do we find out? Proportionately, that's what we have to think. So see, now first of all, what should be the rate over here? You can, between 4 to 6, it is 2 years. In 2 years, the rate has gone up by how much? Take the difference. 2 years, it has gone up by how much percentage? 1.48 minus 2.15.
0.67.
So 0.67 percentage. So for 1 year, how much will it be? 0.67 percentage divided by 2.
0.335%. Yes.
0.335 percentage. So that means it will go up each year. It is increasing by 0.335. So plus 0.335 percentage you do.
1.815.
Uh, the value of x is 1.815, right? Okay.
Yes.
You have added no this one. So no 1.815 this one, right?
Yes. Yes.
Okay. Now how do I do? See this difference will come here as well. So what is
Okay.
this difference? 1.815 minus 2.64.
0.825.
So same thing you add up here as well, difference, and you will get the value of x, 0.825 percentage.
2.975.
That's it. So now, did they ask the
No.
price or only the yield? So 2.975. That's it. Just proportionately calculating.
So it's just using the
Proportionate
existing
method.
values and finding it out.
Yes.
Well,
Okay. Okay, then should I continue then this sums? Effective
I
annual
think
yield.
we could go. This is like the last.
Huh?
It was last sums of 52 anniversary. So I think we should start the uh, theory.
Okay. I'll start from the ending then theory. 65. Okay. Mortgage backed securities. Now remember this, I have already told you about this, what mortgage backed security means, that recession and all. Okay.
Yes, yes.
So it is that topic only. So that shortly I'll tell you again. So bank is issuing home loan and then they are selling it to special purpose entity or investment banks, okay, or government sponsored entities. That money is again is is issued. Okay, this is issued as investments, which is called mortgage-backed securities or asset-backed securities. Mortgage-backed securities means backed by home loan. Asset-backed securities means backed by all other loans like personal loan, credit card loan, student loan, all this. Then here comes CDO. CDO means this Mortgage-backed securities will be further categorized as senior secured, and unsecured. Okay. So now what is prepayment risk? Prepayment risk means risk that he has borrowed for 30 years, but he will pay after 5 years. Who knows? Right. So that is called prepayment risk. Why? Because when he is paying in 5 years, still here, whatever they have promised, they have to continue that payment. So there is a mismatch. Okay. So that mismatch has to be handled by these intermediaries only. They will invest that money, whatever money has been prepaid, somewhere else. So there is a risk for them. It is not a smooth flow of cash. So that is called prepayment risk. Extension risk. Okay. Extension risk means what? Sometimes he said 30 years, but he might be taking 40 years also because he lost the job in between. Those problems are also possible. Then it becomes extension risk. Okay. Now, contraction risk and prepayment risk are same only. The risk that prepayment will be faster. The risk that prepayment risk, uh, the risk that prepayment will be faster than expected, leading to cash flows arriving sooner than expected, is called uh, contraction risk. Contraction risk and prepayment risk are same only. Okay.
Okay.
Then one way to reapportion the prepayment risk inherent in the underlying asset pool is to use time tranching. In the MBS structure, an MBS with time tranching will have different bond classes with different maturities. Contraction and extension risks still exist. That means based on the time. See, instead of saying senior secured, this will be like in 5 years, in 10 years, and then in 15 years. Like this also, it might be structured. Okay. That is time tranche. Tranche means group. Like these are certain groups. These are groups. These are called as tranches. Then residential mortgage loan. Residential, now these mortgage backed securities can be residential as well as commercial. So if it is backed by residential, then we'll say residential mortgage backed securities. That means RMBS or CMBS. That means collateralized mortgage backed securities.
Mm.
Then these are the common features. Recourse and non-recourse loans. Now, what do you mean by recourse and non-recourse? Rest all are common points only. Uh, Non-recourse loans means, say for example, you are taking home loan. So when you are taking home loan, uh, okay, when you are taking home loan, um, say for example, later on you are not able to pay. So what will the bank do? Bank will maximum can seize this property, can seize the home. Can they come and force the borrower to sell his other personal property and pay? Yes or no? Or say for example, automobile car loan. Now you are not paying. You have taken car loan, and after a few years you are not paying. Can the bank come and seize car loan? Yes. After seizing car loan, still if they are not satisfied, if they want more money, can they ask you to sell your home and give it to them? Yes or no?
No?
You have taken car loan.
Okay.
Okay, after a few years you are not able to pay the loan amount. So bank comes and then takes over the car.
Yes.
Now, can they ask you to sell your house also and pay off the car loan? Yes or no?
No.
No, right? So that is called as non-recourse loan. Non-recourse. They cannot come and ask you to sell your personal property. If this would have been recourse loan, then they can come and ask you to sell your personal property. You got the difference?
Yes.
Recourse loan and non-recourse loan. Now you may just quickly read this. Initial 4-5 lines, if you read also, it is okay.
Yes.
Hmm.
Yes. Yes.
Done, right? Okay. Then this part all you may ignore also. All these are there in FSA, but roughly loan to value means, say for example, you are giving gold, you are taking gold loan, so you are giving gold worth 1,000 rupees. What do you think
Okay.
you will get loan for how much amount you will get loan for if you
900.
give, huh?
900.
Okay, 900. Okay, fine. So 900 is also too much. Only around 700, 800, 30 percentage around less only you will get 30-40 percentage. So
Okay.
okay, but still it is fine. Only 700 or 800 you will get loan. So that means 8, that is loan to value. Loan is 800 for the value of 1,000. So just calculate this. 80 percentage. So 80 percentage is loan to value. That means if the value of the asset is 100, collateral value is 100 rupees, what is the loan that they can take it for? Is it okay?
Yes.
Then similarly, debt to income. So debt to income means, uh, say for example, your debt EMI is 50, 20, 30,000, and your income is 50,000. So just calculate this one: 30,000 divided by 50,000 into 100. Just with the name itself, you can understand this one.
60%.
Yeah. So 60 percentage is debt to income ratio.
Mm.
The sums are not needed. All this you can ignore. Prime loan, subprime loan. Prime loan means creditworthy borrowers loan.
Mm.
Subprime means not creditworthy. They are not good borrowers.
Yes.
So RMBS, I told you, residential mortgage-backed securities, and agency represents government. Government means this one, GSC. Okay,
Okay.
government-sponsored enterprise are called agency. Agency. Okay. And non-agency means private entities such as banks that have no government banking or no GSC, government sponsored enterprise guarantee. Those are called non-agency RMBS. Those are the terminologies you need to know. Then this one, weighted average maturity and weighted average coupon. So let's just do this sum only. It's easy. Just go through this sum once. read the question? Okay.
Yes.
See, now the question is weighted average coupon and weighted average maturity. Okay. So weighted average maturity, see, this is beginning balance. You leave this beginning balance, doesn't matter. Current balance only matters. Original term doesn't matter. Beginning. Currently, what is the maturity? So this third column and fifth column are not required. Okay. Third and fifth. So weighted average maturity, how will I calculate? So weighted average maturity and okay, current balance. This is the balance. Okay, weighted average maturity. So maturities, we have to give weight to that maturity. So weight we will give based on the current price. Weighted average maturity. Okay. So current balance is 90, 72, 247. Okay. This is balance. And maturity is 210, 100 months and 280. Just take this total. First one, what is the total? It's not required. This total.
Hmm.
What is the total here?
For, which one? First one, right? Balance
Yeah, yeah.
409.
Huh. How much?
409.
409. Okay, so you have to just put weight to it into 90 by 409. Weighted average maturity. How much?
46.2.
46.2.
Yes.
And then second one, this one, 409. Okay, denominator.
17.60.
Here,
169.09.
169 point.
09.
This is what weighted average maturity. Overall, you calculate all this. Add up all this.
$232.89.
233. Okay. Similarly, we have to do for coupon also. Coupon is here, they have given interest. No? So similarly, now this is 2.6 percentage into 90 by 409. Calculate.
Calculate what?
Calculate this one. This is weighted average coupon.
2.6.
2.6. Second one, 1 percentage.
0.0057 percentage.
0.0057. Okay, this one
0
third
point,
one
sorry, it's like 0.572 percentage. For first
0.572.
one.
Third one
For first one, I was saying
2.6 percentage into 90 by 409. How much is this? Keep storing the number.
0.572 percentage.
Then 1 percentage into 72 by 409.
0.176 percentage.
Third one
3.261%.
you add up all this.
4.009%.
4.09.
09%. 0.009.
Okay, fine. Here it is. Okay, just note it down now. Weighted average maturity, weighted average coupon. Once done, you let me know.
Yes.
Once done, you let me know.
Yes, yes. Done.
Now, similarly, CMO. So, CMOs are securities collateralized by pass-through mortgage-backed securities and pool mortgages. Each CMO has multiple bond classes that have different exposure to prepayment. The total prepayment. So this is actually, they are speaking about CDO only. Those are all interchangeably used terminologies. Here they are calling this as CMO. Okay, CMO, collateralized mortgage obligations. Then only whatever I'm marking, that if you read, that is also okay. Here this part you have to read. Other, there are various structures how it can be structured. There is no limit based on the time, based on the seniority, then based on other factors also. So other CMO structures include Z tranche, principal only securities, interest only, floating rate, all this. Okay, we'll see all this now. Okay, let's see this now. So Z tranche means what? Z tranche is similar to zero coupon bond. No periodic interest paid. No interest paid during a specific accrual period. After that only they will pay. No interest payment during a specified accrual period. Okay. Instead, during the accrual period, the tranche accrues interest extra principal. Okay. So for example, yes, Z tranche with a coupon rate of 5% has $100 of principal outstanding at the start of the accrual period. At the end of the first period, the principal amount of the Z tranche would be increased to 105. That means it is similar to zero coupon bond. Whatever has to be paid, it will be paid at the end. Okay, and it is the lowest ranking. So these are one or two characteristics you have to remember. Lowest ranked CMO. Okay. Then principal only securities. That means comes purely from the difference between the price paid and the repayment of principal. Again, this is similar only. These securities pay only principal from the collateral pool. Hence, they are effectively zero coupon securities. Yeah. So effectively, same way only, zero coupon securities. Okay. Just the structure is different. Here they are saying the interest payment will be added. Here it is purely zero coupon bond. You pay this, I will pay that. That way. First one, same concept, but they are saying I'm increasing the coupon, and at the end I will pay you that coupon in one go. Okay, just the structure. It's like 100 rupees now. Slowly every year, 10 rupees I will increase, and I will pay you 150 here. And in the second one, they are directly saying I will take 100 and I will pay you 150. Okay, interest only securities. Interest only tranche. These securities pay only interest from the collateral pool. Decreasing interest rates and increasing prepayment speeds harm interest only tranche holders because their return comes purely from coupon payments on outstanding principal. The sooner the principal is repaid, the fewer uh, coupon payments interest only security investors receive. Okay, this is interest only. Floating rate also. This is here the key words are these. This one you can remember is the tranche. Okay, then pack. This one is important. So pack means what? Principal planned amortization class and support tranche. These are two tranches. Just like here tranches are there. Here planned amortization class and support tranche. So planned amortization means between a certain range, if anything happens, this will take care of. They will get. Say for example, if the prepayment level is between this level. Okay, okay, let's read that and then I'll come to this one. Just see this one. Your principal, a planned amortization class tranche is structured to make periodic payments to investors as long as the prepayment speed remain within a certain range. So as long as prepayment is within this range, then these people will keep getting the payment. If it goes outside the range, okay, conversely, prepayment speed decrease. Principal repayment to the support tranche are curtailed. So the scheduled pack payments can be made. In this way, both extension and contraction and extension risk are reduced for pack tranche investors. However, this protection is limited by the range of prepayment speed under which the support tranche can operate. Should speeds move outside this range, the pack tranche will not receive payments in line with its planned amortization schedule. So as long as it is within the range, they will get the payment. If it is outside the range, they are not going to get the payment. So it is as good as all you have to remember here is if prepayment is within the range, pack tranche will get the payment. If prepayment is within the range, if prepayment is within the range, uh, if prepayment is within the range, pack tranche will get the payment. Okay. Then if prepayment speed increases, then only the support tranche will receive the payment. Is it okay? Understood?
Yes.
If it is within the range, pack will get. If it is more than that range, support tranche will get. Okay. That is the only point here. Speed should move outside the range. The pack tranche will not receive payments in line. Okay. Commercial, this I told you, commercial mortgage backed securities. This not required. This is there in FSA, so they will not ask you. Loan to value we have already done.
Oh,
Call protection. Call protection means they will not call back. Uh, this all here not required. You don't have to read all this. You understood the difference between balloon payment and balloon risk. Balloon payment means lump sum amount being paid in one go, like zero coupon bond. That is balloon payment. Okay, that's it. Just go through this again once for a minute. But whatever I told you, if you focus on that one, it is more than enough in this chapter. Okay, you just you may refer if you want for a minute, and then we'll begin with the previous chapter. Then.
yes.
Okay, this is okay.
Just a minute. Done.
Okay. Then the previous one, asset-backed securities. So asset-backed securities, same concept, but backed by all personal loan and all those. So covered bond here, covered bond means what now? Covered bond is, say for example, there is non-banking financial company, let's say ICICI Bank, or banking financial company, bank or non-bank, but financial company. Now in their balance sheet, they have 1,000 crores home loans. That is their asset, 1,000 crore. Now they want to raise bond for 200 crores. So they will go to the public, or let me give you some other ground level example. Say for example, you are going to a shop to buy tomato, and that tomato guy says you pick the tomato on your own. So will you feel secured or not? Now the probability to pick good tomato will go up, correct? Understood? This is the first security you are getting, because when you are picking tomato on your own, less chances that it will go bad. Fine. Then what happens is you are taking it to the home. When you are taking it to your home, uh, when you're taking it to your home, uh, when you're taking it to your home, um, then later on you are finding that when you take it to your home, later on you are finding that the tomato is gone, rotten, something happened in between. Now imagine you are, so if you go back to the shopkeeper, the shopkeeper says again that don't worry, you keep that rotten tomato here, again you pick another good tomato and go. So that means you are getting dual safety over here. First safety is what you only picked. Second safety is even if you pick wrong one, still the shopkeeper is supporting you. So that means the risk is covered completely over here. Is it okay?
Yes.
Similarly, now here in covered bond, what happens is ICICI Bank says, look, investors, I'm issuing bond worth 200 crores. Okay, now this is a covered bond. Covered bond means they get dual recourse. Okay, dual recourse. Yeah. What does this mean? Dual recourse. Dual safety. First one is uh, they are saying, look, how will I repay? How I will repay is from this 1,000 crore bond, I will segregate 200 crore bond, which are all prime borrowers, good borrowers. So there are less chances that they will not pay. So first safety, hand-picked all good borrowers. So now that is the first protection for this investors. Now worst to worst case, then what will happen? Suppose if 10 crore people are not paying, worst case, then the bank says, okay, don't worry. If that ever happens, I will again pick another 10 crore from here, best one, and I will give it to you. That means second, opportunity also you are getting. So that's why it is called dual recourse. That means now the risk is very low in this bond. Understood this one? Okay. I have a video also. I mean, see, videos are there on almost everything. Just I'm sending this to you in case you want to watch later. You may watch it. Okay. Then hard bullet covered bond, soft bullet covered bond. This is just self-explanatory only. Hard bullet covered bond means if the issuer fails to make a scheduled payment, it is defaulted. Very clear, defaulted. Soft bullet covered bond means they can delay the payment by one year, postpone the original scheduled maturity by as much as 1 year. So soft bullet covered bond. Okay, soft and hard bullet. Hard means no change. If you default, defaulted. If you delay, defaulted. Soft bullet covered bond means you can delay by 1 year. Then over collateralization, excess spread, those are all common points only. The, even if you skip all this, it is all fine. This is all not required. Okay. Equity tranche you may read. Equity tranche, the name itself says this is a group which has lowest risk. Lowest ranking tranche has a residual claim to the any left out value. That means after paying all the other groups, this tranche will be paid. So it is called as equity tranche. Okay. Then waterfall structure also this one only. How the payment will be done. First to senior secured, then secured, then unsecured. These are called waterfall structure. That means the line of payments, how the payments are being done. Credit card. Credit card, yes, credit card securitization structure will typically include a lockout period or revolving period during which ABS just go through this line, this paragraph.
Yes. Hello?
Ah, read?
Yes, yes.
Okay. You understood this one? Lockout
Yes.
period or revolving period during which ABS investors only receive interest and fees paid on the collateral. If the underlying credit card holders make principal payments during the lockout period, these payments are used to purchase additional credit card receivables, keeping the overall value of the pool relatively constant. That means if it is paid sooner, like here prepaid,
Oh,
here imagine these are credit card holders, credit card holders. So if they prepay sooner, then that money they will invest further. Okay, and then so that they can pay to the investors on time. Okay. Then solar ABS backed to buy loans to homeowners wishing to finance the installation of solar energy. Okay, just one same concept, just one backed to buy solar energy related. CDO, just go through this one. Yeah, CDO is a structured security issued by SPE or for which the collateral is a pool of debt securities. When the collateral securities are corporate and emerging market debt, they are called collateralized bond obligations. Collateralized, yeah, just go through this one. Here the point to be noted is CDOs, CMOs, all these are interchangeably used terminologies only. And what the additional point that you need to know is that what sets CDOs apart from regular ABS is that CDOs have a collateral manager who dynamically buys and sells securities in the collateral pool to generate cash to the promised payments. to make the promised payments to investors. So they will keep buying and selling also all these securities.
Hmm.
Okay, you may just read this paragraph once. Hmm? Is it done?
Done.
Then rest all you don't have to read there. Okay, this is also done, right? So two readings done. All these are small readings only.
Yes.
Ah, fixed income securitization. So securitization is purely this mortgage. This is securitization. Securitization means the process of converting home loan mortgages into a security and issuing it to the investors. That is securitization. Originator means the bank is the originator here. Okay. So here all these are not required. Bankruptcy, remote, these are not required only. You can read this part. Just see if you are able to understand this. Special purpose vehicle is a separate legal entity from Fred. Fred, okay, this is Fred. See, acha, this is what customers buying cars, they are going to Fred Motor Company. Then Motor Company is going to some sort of special purpose entity and they are connected. See, what it means is it is as simple as imagine you are going to buy Bajaj bike. When you go and say I want to buy Bajaj bike, so an investor customer is going to Bajaj Motor, Bajaj bike, Bajaj Auto to buy bike. So will Bajaj Auto take you to ICICI Bank? No, they will take you to what? Bajaj Finance. Okay, and then Bajaj Finance, then they will connect you to the customer. Okay, Bajaj Finance, car loans. This is investors. So investors are giving money to Bajaj Finance. Bajaj Finance is giving money to Bajaj Auto, and that's how they are doing the business. You've seen how the money is rotating. Okay, now in this case, Bajaj Finance is bankruptcy remote. Why? Because all they have to do is to keep receiving cash from the customer. Their job is only to receive cash from the customer. Okay, so these special purpose vehicles are considered as bankruptcy remote from the originator. Because if the originator is becoming bankrupt, also this has been given a separate legal entity. This has been given a separate legal entity. Okay. Okay. Oh, it's all over only. It's very small. That much only. Okay, this is fine.
We continue the other LOS in Sunday.
Okay. Then we'll stop now here. Then
Yes.
okay then. Okay, we'll continue tomorrow then. Okay. 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 Bye.
Thank you.